Welcome to strategic training videos on how to pass your securities exam. In this video, we're going to be covering preferred stocks. Now, what is a preferred stock? A preferred stock is a stock that is issued with a stated dividend. This stated dividend means the shareholder knows exactly how much they're going to get paid on every share that they own. It's stated as it could be a percentage of par or as a dollar value. The par value of a preferred stock is $100. So what that means, if the dividend, say example, is 5%, then the shareholder is going to get $5 per share, which is 5% of 100. Or they could simply say they're going to get paid $5 a share, or they could say 5%. Dividends are not guaranteed. The dividends must be declared by the board of directors. So even though the dividend is stated, that means the shareholder knows exactly how much they're going to make, they don't know if they're going to make money. So the shareholders know they're going to make, say, $5 a share. That's assuming that the company makes it, they declare the dividend. But if they do declare a dividend, it's not going to be more than 5%, and it won't be less than 5%. So they know exactly how much they're going to get paid if a dividend has been declared. Common stockholders really don't have any clue how much and if they're going to get paid a dividend, because the company does not have to declare dividends, and if they do, it depends on profits and how much, what they declare that dividend to be. Preferred stockholders do not have voting rights. One of the main differences between preferred stocks and common stocks is common stocks have voting rights, preferred stockholders do not have voting rights. Preferred stocks get paid before common stocks. So they get paid dividend before common stocks, they get paid before liquid common stocks if the company goes out of business. What that means is preferred stocks are senior to common stock. Any security gets paid before. Another one would be senior. Common stocks get paid last. They are called the most junior or the least senior security. So price of the preferred stock, par value is $100, and dividend is paid at a percentage of par. We just mentioned that. But the current market value of a preferred stock is not necessarily $100. It's inversely related to the interest rates. So when interest rates increase, the price of the preferred stock is going to drop. And similarly, when the interest rates decrease, the price of a preferred stock will rise. This works the same way for bonds. The par value of a bond is $1,000, but that's not necessarily what the bond is going to be selling for in the secondary market. So the current market value of a preferred stock would be the price of the preferred stock in the secondary market, and they're inversely related to interest rates, just like the way it works for bonds. Now let's look at the different types of preferred stock. The first one is called straight preferred or non-cumulative. These shareholders are going to get paid a dividend only when the board declares a dividend. So if they don't declare a dividend 1 year, the shareholders do not get paid anything. Cumulative preferred stock, they have the rights to previously unpaid dividends. So if a company doesn't declare a dividend in a certain year, they do get paid a dividend in the following year when the company declares a dividend. Unpaid dividends get paid before any dividends are paid to straight preferred or common stock. What that means is the company doesn't declare a dividend, say, this year. Next year, they declare a dividend. They make a lot of money next year and they declare a dividend. They have to pay what's called the arrears. This is the unpaid dividends for the cumulative preferred stock. They have to basically catch up. So if they pay $3 a share and they miss 2 years, then they have to make up that $6, $3 per year, and then they could pay the current year preferred stock dividend. Convertible preferred stock. These stocks convert to common stocks. So you have the option to stay as a preferred stock or the option to convert to common stock. Because of that conversion feature, which is a big benefit for investors, they're gonna pay lower dividend than straight preferred stocks. So the downside to having a straight preferred is if the company doesn't make a declaration that year, you're out. But the upside to having a straight preferred, they have the highest yield because of taking more of a risk. You're gonna get paid more. So anything that's convertible, whether it be convertible preferred stock or convertible bonds, they're gonna pay lower than their non-convertible counterparts. So on the exam, they're gonna say which of the following would be used to maximize income. You never pick the convertible anything if you're looking to maximize income. If the person is looking to maximize income and the question says which of the following would be least suitable, then you would pick the convertible. So keep in mind, convertible pays the least amount of money. Callable preferred stock. Anything that's callable can be called anytime after the call date. So what that means, and this is also true for bonds, you have a callable preferred stock or a callable bond that could be called, say, after 5 years from the date of issue. Why would the company issue that? Because they want to buy back their stocks. They want to basically call them back and reissue newer securities, in this case preferred stocks, at a lower dividend. So if the stock was issued with 5% and interest rates now drop, well, the company doesn't have to pay that much of a rate. So what they do is they would call them back. So it could be a 5-year non-callable period. So after the 5 years, then basically the investor is skating on thin ice. Anytime the company could just call back that bond, that preferred stock. Now they are going to be called at a premium, and whatever that premium is going to be stated on the stock, that the issuer is going to pay you more than the par value. That's what premium is going to be higher than par. And preferred callable stocks usually get paid when interest rates fall, and this is similar the same way it works for bonds. Participating preferred stocks, these participate in additional profits. So what does that mean? So they're gonna get the straight preferred dividend, or when straight preferred get paid, they're going to get paid as well. So if you have participating preferred stock, you're going to get the preferred stock dividend, just like any other preferred stock. But what happens if the company has additional profits? They're going to share those dividends beyond what the straight preferred get paid. However, in this case, the issuer must pay the dividends first to the common stockholders. So they get straight preferred stock dividend, say 5%, they're going to get the $5 a share. And then the common stock dividend is going to be paid. And then they're going to pay the additional profit to the participating preferred stockholders. Okay? So after paying the common stocks, participating preferred stocks get any remaining dividends. So this could potentially get, say, 8%. The 5% dividend that they get paid because they have a preferred stock. The company also declares a dividend to the common stockholders, whatever, it could be 7%, for example. And then the additional 3% are going to be paid to the participating stockholders, but after they pay the common stockholders. Okay? If you like this video, please give us a thumbs up, and please subscribe to our channel. We're going to have videos coming up, and you can see the videos as they come up. And if you please leave us a comment, we'd love to hear your feedback.